I would like to welcome our presenters today, Ted Bililies and Josh Tecchio. Ted is Chief Talent Officer and Managing Director of the Transformative Leadership Practice at AlixPartners. Ted is an expert on leadership and organization who helps CEOs and investors solve their toughest people and organizational problems. Via his training as a clinical psychologist and teacher at Harvard University, Ted helps global leaders achieve enduring change in their organizations, their teams, and themselves by expanding their psychological, behavioral, and organizational insights. Josh is a Vice President in the Transformative Leadership Practice at AlixPartners. Josh works with clients to identify and implement human capital and organizational solutions to support their strategic objectives. He works across industries, most notably within private equity firms and their constituent profile companies, drawing on years of experience conducting applied research. Josh is an expert in executive assessment and holds degrees from Columbia University and Georgetown University. It is now my pleasure to turn today's program over to Ted Bililies and Josh Tecchio. The floor is yours.
Great. Thank you, Mike, and good morning, good afternoon, and good evening, everyone, and welcome to our AlixPartners webcast. Looking forward to sharing the next hour or so with all of you and with my partner, Josh Tecchio, as we go through our 4th annual Private Equity Leadership Survey. We've been doing this for several years. It's yielded wonderful results, thought-provoking results, and I think we've already begun to feel like we've made an impact on investors and on management teams that have taken a lot from our findings, and hopefully today's review of our 4th annual will be equally valuable to all of you. So just to say a few words about the survey itself before we dig in to the findings. We had 152 respondents across 54 private equity firms. We had managing directors, operating partners, and we had 98 portfolio company respondents, all of whom were either CEOs and CFOs. This year's survey was really focused on the proactive management of the relationship between PE sponsors and Portco CEOs and CFOs. We deliberately included CFOs this year, which was different for us for a couple of reasons that we'll elaborate on as Josh and I talk about our findings. But needless to say, it's an extraordinarily important role, and by looking at the relationship between CFO, CEO, and PE sponsor, we're looking at a whole new dimension, a whole new relationship dimension that oftentimes is not taken into account when people are considering buying and selling companies, hiring and firing management teams. We focused on the early understanding of major misalignments related to the role of human capital in private equity firms' investment theses, and we looked specifically into the disconnections between beliefs and behaviors with regard to pre-deal assessment of prospective portfolio companies. And again, we'll go into a lot more detail throughout this hour. So basically, we can, in some ways, one headline from the study is that private equity firms are seeing that investment success isn't just about the numbers, it's about people. So that when we sampled private equity investors, they cited human capital as their number 2 biggest concern to receiving IRR, to receiving a good return on their investment, second only to growth. And on this side, you can see how the two groups, Portco executives and PE investors, responded. So, we ask versions of this question every year, and it's going up and up. So the good news is human capital looms large, features large in terms of what private investors are thinking about actually pulling the trigger and making an investment. What we'll talk a little bit about as the program goes on is that sometimes their follow-on behavior is in line with prioritizing human capital, and sometimes it's not. And that's where we feel we can make the most contribution, because we think there are opportunities of really managing human capital and leveraging human capital for better return in a much better way. So before we go any further, we'd like to do a live poll. So please take a look at your screen and your response buttons, which are coming up, and answer the following question. How often do you assess alignment of the PE-CEO-CFO relationship during the due diligence phase? You've got about 15 seconds to answer this question. And while we're collating results, because we're going to show the results in just 15 or 20 seconds from now, I just want to repeat again that this is the first survey that I've seen anyway that tries to dimensionalize the relationship between the board or the sponsors, the CEO, and the CFO. And it's the triangular nature of that relationship that we're going to be talking to in more detail. So we're going to be getting some early returns coming in.
Appears we might have had some difficulty with the question polling itself. Not a worry, though. In any event, what we were looking to see is, those of you that bucketed in the always and often area versus the rarely and never area. Both of those groups. It seems that the question is going to be resubmitted. If you want to take another 15 seconds to log your answers.
Yeah, we're going to do this 2, maybe 3 times in the course of our presentation, and if the technology cooperates, it's really very helpful to get a live poll.
Excellent.
Oh, doesn't look like it. Oh, there we go. Okay, so 40% of you said always, 20% of you said often, and 40% said rarely. Excellent, excellent. So that's certainly something we can build on as we go forward. So Josh, let's get to the next slide. So more about this triangular relationship that we think is so important. We think that because it is a relationship and because it tends to be, it historically tends to be neglected. For example, 50% of PE investors view the CEO-CFO relationship as extremely important, but much less than 50% actually conduct assessments of that relationship or, in fact, of the whole team. We think that certain issues can arise, everything from jealousy and mistrust to poor communication and misaligned expectations. And you'll see as we get further into the data, that's precisely what does happen. Frequently, the board will go directly to the CFO for information that they need. If that CFO doesn't have a strong relationship based on trust with the CEO can become threatened. And of course, the mirror image of that can happen. There are implications in terms of early on in the relationship of pre-deal and how do you assess that, but there are really significant risks in terms of after the close, as the deal unfolds, how are those relationships being managed? And that triangular relationship can be so antithetical to building trust. We're finding that when we look at the other end and we see why deals fall apart or why they don't deliver the returns that they have, frequently we can go back to the very beginning and see, what was the strength or lack thereof of this relationship.
And as Ted's saying, there's 3 key timeline junctures that we tend to consider when thinking about the analysis of this relationship dynamic, one of which, is, as Ted mentioned, is somewhat problematic in the sense that getting access to management teams during due diligence can be somewhat difficult, yet it can be done to a certain degree. The level of depth of data that can be gathered is increased post-transaction as access is increased and as folks are now delivering on their accountability. But then, arguably, it should happen at a third juncture, which is downstream within the investment cycle, to understand whether or not the dynamics have remained intact, whether or not there is still healthy communication, and whether or not people are still clear on what their role actually requires.
And I would just add before we move on, Josh, that when our participants in these surveys say that they do assess, they can mean any one of a number of things. They can say, they can mean, well, I had a conversation with the CFO, or I took the CFO out to dinner, or I used a third party to actually formally assess, the CFO. So it's, what's really, really important here, and we'll make this point a couple of times as we go forward, and that is that it really is absolutely critical for a PE sponsor to be really trained in and understand what assessment means and how you actually determine whether an individual has the required traits, skills, and abilities to be successful in a role, and by the same token, that role be very clear and very, very clearly defined. And we'll get into that as we go along. So, signs of trouble in the PE-CEO-CFO relationship triangle. Investors, CEOs, and CFOs who filled out our survey shared their individual perspectives on what tends to go wrong. And we were surprised and impressed by the fact that there was a lot of similarity between those perspectives. Basically, collaboration breaks down. Misalignment on the strategy breaks down. Communication goes from more frequent to less frequent. And essentially what's happening here is that trust is actually eroding. And like in any relationship, when trust erodes, people assume things that may not be true. They don't share things necessarily in a timely way. Others may believe that there's a hidden agenda, and this can really unwind a productive relationship. And when we do the so-called exit interviews, when CFOs are leaving a portco or CEOs are leaving a portco, this is basically what they're saying. And our uber thesis here is that, in many of those cases, that can be avoided.
Mm-hmm. There is a differential here, which is on the private equity investor response side. Pardon me, and that's the third line here, where you see differing perspectives on the company's financial performance. And this can mean one of two, if not more, things. The idea that financial performance is in some way interpretable. We are of the mind that numbers are numbers, and that success should be defined beforehand, at least at the very beginning of the investment cycle. But that sort of bleeds into the idea that successful financial performance should have clear expectations that are aligned upon between the investor pool as well as the portfolio company leadership as early on in the investment as is possible. This idea of differing perspectives should be addressed early, so that a year or 2 years into the investment, we're not looking at misunderstandings and misalignments on what's expected for the rest of the cycle.
Great. So just to double click a little bit further, mutual understanding, a key to building trust and fostering candid communication. So when we asked each respondent group what they wished that the other groups would better understand about them, we got some very, very interesting responses. So for example, we asked our private equity sample, what has been the one thing that portco CEOs need to better understand about their board, about their sponsors? And here, not surprisingly perhaps, there was a key theme about urgency, about the importance of the investment timeline and how important that is to the PE investor, and that the insistence that we act quickly on value-creating priorities. PE respondents identified factors that are critical to constructive relationships with their CEOs, not surprisingly, like trust and open communication. From the CEO side, key themes were slightly different. They were more around alignment and execution. Let the CEO run the company was a comment that we frequently heard. Also, it's never been a tougher time to be a CEO. So many obstacles that are outside of our control, and the implication there being that the board could do a little bit better job of having empathy and understanding the multiple priorities that the CEOs are juggling. Now the CFOs, and again, if for no other reason than this finding alone, I'm very, very glad that we included the CFOs in this survey, and some very, very important themes came out. Certainly alignment and execution, much like the CEO's concern, but there's a wish that CFOs have for their boards that goes as follows. understand that I, as a CFO, am actually running the firm too. I'm not your bean counter. I'm not just your numbers person. I have operational responsibilities, strategic responsibilities, and management responsibilities. And if there is a kind of almost subtext of our findings, it was CFOs deserve more respect. And we're already planning kind of our next bit of research, because we think that when CFOs leave and turn over, this has a lot to do with it. That they're being put in a box, they're being put in a role, and if the board isn't careful in the way they treat the CFO, they're going to raise the turnover rate, essentially, of that key professional. So let's dig down a little bit deeper in the misalignment around the importance of human capital. So PE investors are saying that next to growth, the only thing next to growth that's as important is how we value people and how we position people for value creation in the asset. However, 52% of investors also named operational efficiency versus 30% of Portco investors. So human capital remains a top concern, and it certainly remains a top concern for CEOs and CFOs. But there's a disconnect with private equity investors who tend to say one thing but don't always act. For example, not many private equity investors make talent assessment a priority or an early priority in their investment thesis.
Yeah, the message from what you're seeing here really is on this idea of earliest is best. Because what we're seeing reported is that human capital is, again, the number 2 concern for value creation and value driving with our portfolio company investments. Yet, by and large, it is not a key factor in the decision to actually invest. We see reporting still falling imbalanced towards operational efficiency, cost takeout, yet the human capital side of things, despite its importance, is not being considered as part of the decision to invest.
Great. So again, a little bit more about executive assessment and CEO turnover. When our private equity clients talk about CEO replacement, 40% indicated that they upgrade the Portco executive teams, but they wait more than a year to replace the CEO. And 72% of Portco's existing management teams still end up replacing the CEO after 1 year. So again, although investors believe assessments are vital, only half said that they always or often formally assess CEOs and CFOs, and even when they do, they tend to drag their feet in terms of replacing people and waiting too long in these leadership roles.
Well, we don't want to jump ahead of the data, but there's going to be a point later made that this is a very risky and dangerous timeline to assume. Understanding that having a qualified and competent and high-performing executive at the top of the house as early on in the investment cycle as you possibly can really is going to have a major cascading and waterfall effect down the line in terms of your returns.
So another thing that we found here that is from our respondents is that we assess CEOs and CFO candidates differently. And this may have something to do with turnover rate. So CEOs tend to be evaluated spontaneously or not according to a planned schedule. They're evaluated on drive and work ethic, on people and leadership skills, and on personal compatibility. CFOs tend to be evaluated but based on their financial skills, their previous experience as a CFO, along with their drive and work ethic. And we think that this may be very, very limiting, perhaps a bit unbalanced between those two roles. We heard from CFOs, again, I'm also an operator in this firm. I also manage people. I'm more than just a numbers person. And many CFOs really feel limited to and really, quite frankly, in a sense, put down and restricted. And their evaluation measures really show that. On the other hand, CEOs can almost be overvalued, and we would argue that CEOs could use a bit more rigor, structure, and formality in terms of how they're assessed and evaluated.
And in terms of human capital as a general concept, CEOs being evaluated as with regards to their personal people leadership skills, of course, makes sense, and I believe it would to everyone on this call. However, for CFOs, that factor not being listed is largely concerning. CFOs are also arguably, the second in command, most in charge of leading people in the organization. And as many of you know, within certain companies, what we see is the human resource function actually reporting up through the CFO, arguably making that person the overall leader of the people strategy within that firm. So for them to not be assessed for their people leadership skills, we need to be looking at what we might be missing opportunistically.
And just a bit of a highlight here on the disconnect between what private equity investors say is important and what they do. They say that it's very important that CEOs are able to, build, motivate, work a strong team, but they're oftentimes neglectful of the level of self-awareness, emotional intelligence, communication skills that CEO or CFO actually has. And we'll talk about this in our next section, next couple of sections, about the lack of consistency between what private equity investors say is important and actually what they do, meaning what they measure, what they value. There's a significant opportunity for private equity investors to get better at understanding the actual capabilities, traits, skills, and abilities of building, motivating, and aligning a team, and whether or not they're good at assessing it, but being aware of it and choosing their CEOs based on that, thereby bringing what they're claiming is important in line with what they're actually doing. So more on that a little bit later. And then here, a word on culture. And we here at AlixPartners, we spend a lot of time thinking about the culture of private equity investments. We see culture as an output, not as an input, but as a very, very worthy area to be studied. Going back to last year's survey, we saw a dramatic split between the importance of culture between private equity investors and operating company CEOs, almost mirror images, where something like in the high 20s, mid to high 20s for private equity investors stated that they valued or looked at the culture of the operating company, whereas 82 to 84%, this is again last year, of operating company CEOs stated it as important. And we have that, basically replicated again this year. There's generally not a formal diagnosis of culture that's done, which to us is very surprising because many times private equity is investing in founder-led organizations where the founder is the culture carrier, and there may be long-term veteran leaders in the organization who are also culture carriers. And when you seek to, quote-unquote, professionalize the management and start switching people out, you're really risking the value creation thesis. The studies go back well into the 80s of connecting an organization's culture with their financial performance and their financial returns. So we think culture is an absolutely essential part of the people equation. It's consistently represented as important by management teams, but it continues to be neglected by private equity investors.
Yeah, we see the assessment and the diagnosis of culture as really a validation exercise of the investment thesis itself, of the strategy. There's, I'm sure most, if not everyone on this webinar has heard the Peter Drucker phrase, culture eats strategy for breakfast. We'd add that it probably eats it for lunch and dinner as well. but it is a tried and true statement. Even the best baked strategy plans in our experience are completely laid to waste if a culture does not support it for whatever reason. We're going to speak on some case studies in a moment, and we'll get into a little bit more depth about how we've seen that and how we can realign culture with the investment thesis, with the strategy, and with the overall execution tactics. Because what we take into risk without understanding culture is that our strategy has no support, either in the leadership or within the rank and file employee pool.
And culture, finally, is very vulnerable to the private equity, to the sponsor CEO-CFO relationship and the whole triangular relationship that we're talking about and researching here. That if there's mistrust that festers, if there's misalignment that festers in any one aspect of that triangle, that's going to have a deleterious effect on the culture, which is in most cases, if not all cases, so closely connected to a productive and successful investment. So let's actually get really grounded in some recommendations and case examples drawn from the work that Josh and I and many of our colleagues have done. But first, let's try our hand at another poll question. Quickly, how often do you assess the senior executive team during the due diligence phase? Always, often, rarely, or never?
And here I think the important piece really is the due diligence side of things. So thinking about that timeline, thinking about those critical junctures of when these assessments can and arguably should be taking place, the purpose behind them, the type of data that you can gather, and what decisions are ultimately going to be informed by that data. We want to think about the earlier end of that timeline. How often is that happening?
Great. So 3, 2, 1, we're almost there. And let's see if we can get some results on the screen. Do we have results from the survey? And here they are. 84.5% always assess the senior executive team during the due diligence phase. Often 7%, rarely 7%. Very impressive.
Very impressive indeed.
Yeah, terrific. All right. Let's jump into those case examples.
So this first case example here is really on that same due diligence idea of when it is that we conduct these types of assessments, both organizationally and with regards to the leadership itself, because this type of rigorous assessment earlier on can really unearth some critical misalignment, some critical organizational and leadership strengths that can be leveraged, but then really those potential blind spots with regards to the human capital of the company that's being acquired, that, when put on the investor's radar, can be very helpful in terms of making a go, no-go decision to acquire. So in this case, we were approached by a mid-cap private equity firm who was seeking to acquire a diversified water company and to triple its sales across multiple product lines over their 5-year holding period. Through their financial due diligence process and through the contacts that they had with the management team, some leadership and organizational really question marks had come up on the investor's side that required some further investigation in order for them to be able to make that ultimate acquire or not decision. So our approach was multifaceted and varied, yet quick and targeted. We assessed the potential for the leadership and the organizational improvement opportunities to inform the efficacy of the investment strategy. We do this through a multi-layered interview process where we go both broad and deep, speaking to those at the highest levels of the organization, but then also to the extent that we get access, speaking to the rank and file and understanding, is there alignment on what it is that is going to be expected moving forward? Do we understand what it is that's been communicated to us? Has it been communicated in the first place? And then in the realm of about 30 other dimensions that we measure as part of these very quick turnaround types of engagements. And then, as I mentioned, assessing the senior leadership and org challenges that both hinder and support the overall effectiveness to give reports on what those organizational and leadership strengths are and what those blind spots may be. The impact, as you might imagine, was the delivery of that reporting. We indicated both cultural leadership, and capability strengths within the organization, but then signaled significant misalignments. Understanding that those misalignments were at the root of communication issues at the top, we overall recommended that an executive chairman be appointed to support an interim CEO as that person developed into their role. The plans and implementation processes that we recommended ultimately convinced the private equity firm that they had in front of them a very likely profitable organization that can be grown within the 5-year period. And with those assessments made, decided to go ahead and make the acquisition.
Great. Terrific. Thanks, Josh. Our second case, just waiting to, is it up now? Well, let me speak to it. Our second case really is to address this issue of alignment, particularly in the first 100 days. So what we like to do is we like to conduct an independently facilitated alignment workshop between the PE sponsor and the Portco management team within the first 100 days. We devote the workshop to agreeing on and committing to a set of shared expectations. So just to take a specific situation, a mid-market private equity firm was acquiring a $1 billion heating and ventilation company in the southeastern United States. They wanted to pursue a roll-up strategy. The founder is the CEO, and the PE firm saw an opportunity, again, this word to professionalize the management and improve overall financial performance. 30 days post-close, we brought the sponsors and the management committee together. We had a kind of celebratory dinner the night before, but then we, in a pre-worked agenda for the following day, we really talked about what are the key expectations and what are the key factors we need to be aligned on going forward. What kinds of problems could we anticipate and get ahead of so that we don't end up with unplanned turnover, inefficient use of time, frustration, lack of trust. So we talk about those key expectations for information sharing, frequency of contact, financial metrics, everything related to people, who's in the critical roles, and who may need to move around. Again, this is a semi-structured day where we're really talking about how can we best align ourselves. And by the way, culture is front and center. The how of what we want done. We talk about the what and we talk about the how, and that's culture. How do we actually make the changes, along with what-if scenarios? And that alignment workshop really pays dividends. I've seen it pay dividends for the entire life of the investment, where we actually establish agreements. Who's going to call whom first? If the CFO is going to provide the board with, a certain kind of documentation, the CEO will always be, included in that copy. And we find that there's a direct relationship between trust, misalignment, and shared expectations based upon whether or not we have the workshop and, of course, how well the workshop is committed. To say it differently, we just helped the client exit an assessment that we worked on very significantly 4 years ago, and I simply asked the sponsor. I just said, how important was the alignment workshop that we had at the very beginning? And we got a very, very strong endorsement on it, on how that not just got the different parties aligned and off on the right foot, but really paid dividends throughout the years of the investment, particularly when times got tough, and people could refer back to these rules of engagement that we had established during that alignment workshop.
And our last case study here is around the assessment of culture. We were brought on by an $800 million teletech company to do a diagnosis of its core culture following a recent and major product pivot and an impending exit from their current private equity owners. The understanding that the culture led by what had been, what we assessed to be a command and control CEO had certain misalignments with regards to its messaging. The we do wasn't aligned with the how we do it, right? So Our approach was, again, a very deep dive into the organization, interviewing people both at the top and all the way down through the ranks, and this was globally as well, within the parent and also the acquired company, to determine these cultural strengths and also pitfalls towards the full integration of both companies. The CEO had been indicated as someone that was largely in favor of the acquisition, yet we found that those within the acquired company felt that they had been ignored and that they were essentially being punished for not being part of the core company to begin with. The analysis that we indicated showed some major behavioral blind spots from the management team, which is the cascaders of culture, right? The culture begins at the top. Of course, it is supported at the bottom, but the understanding that folks really wanted to support others in hitting their sales targets. They wanted to integrate the folks from the acquired company and to really leverage the tools and technology that they brought to the table. This message was being lost because the top was so hyper-focused on making sure that people knew that they were in charge, right? So we provided new ways to run weekly results calls. We provided new methods to track performance and to give feedback. We instituted a 360 review process to understand that feedback needed to come from the bottom as well as the top. And ultimately speaking, the culture was improved well enough that the exit happened successfully within the following year and a half.
Great. So we want to switch now and spend a few remaining minutes on part 2 of our annual leadership survey. The fact of the matter is we got so much rich data this year. We're just, we're really excited and very enthused. And so we decided to separate it into a part 1 and part 2, and it'll be released this coming week. So we'd like to give you a preview of part 2 and what we're finding.
So what we see here first are the top priorities for the first 100 days following an investment for a CEO and a CFO, and large alignment following under these 3 key themes. The first of which, ensuring role clarity, we've actually spoken to a few times already in this presentation, thinking about what it means, what the expectation is for my role in order to be considered successful within 6 months, a year, 18 months, throughout the entire investment cycle. We see that falling in a concerned fashion more towards the CFO side of things than the CEO, yet we see a major opportunity, and in our experience providing that type of role clarity for a CEO gives private equity investors and board members a much deeper understanding of what it is, how it is that we need to move the needle in order to grow our companies over the investment cycle. Aligning the leadership team on the strategy, as Ted spoke to earlier, I think quite eloquently, the alignment workshop really serves to get on the table and make explicit what is largely implicit. How we communicate, when we communicate, what it is that is expected from one another, and how it is that we can sort of kick off this idea of creating trusting relationships. And then lastly, putting the right people in the right roles. This is something that, again, needs to happen continuously as our goals change and as perhaps strategy execution shifts. We still need to understand that people are going to be the ones that drive the value. They are going to be the ones that execute. So we need to make sure that in each function and at the top of the house, we have the right people in the right roles. The analysis of the company culture at the bottom there, bit of a higher focus, as we mentioned earlier, on the portfolio side, while sort of a concerningly low consideration on the private equity side, displaying there a significant misalignment, but also a heartening thought on the portfolio side that culture really is what's going to be that drives your execution.
Yeah, and just to elaborate on that, there's a real opportunity among private equity investors out there to really get educated on what culture means and how culture figures ultimately into the IRR of a deal, because it's really, really critical.
So now the actual responses on what the priorities are, splitting them between the CEO and CFO response buckets. On the private equity side, and on the private equity and portfolio CEO side, we see general alignment with some misalignment in the middle there. So overall, there's agreement that establishing and assuring senior team alignment with both each other and to the strategy itself is a top priority within the first 100 days. As well, reporting interface establishment with the private equity sponsor, again, something that is accomplished as part of this type of alignment workshop, establishing cash flow, financial reports, KPIs, whatever those expectations are going to be to show success so that there's no disagreement down the line on what it means to have performed well. Those two things, there's general alignment between the investor and CEO pools. However, the private equity firms are more focused on the validation of their investment thesis, which, as I mentioned earlier, can be accomplished in part through an assessment of culture and a delivery of quick wins. Delivery of quick wins, I think, obviously necessitates having the right people in the right places, understanding exactly what it is that they need to accomplish in order to deliver those quick wins, because the expectations of quick wins without those two very critical components is going to be difficult to manage. While on the portfolio side, we see assessing the management team as a high priority. Again, a heartening reporting on that side, because the understanding there is that assessing the management team ensures that you have the right people in the right roles, that you have them executing on what they need to execute on, and that you can, you can sort of rest assured that there's going to be some type of quick wins from that.
And that they know what's expected of them, so that we're doing more and more work in role analysis, role definition, even beyond specific KPIs. So it's critically important that each role reflect in its own way the strategy, the long-term strategy of the investment thesis, and that the incumbents be acutely aware of what those expectations are. And we're finding with our clients that that's not the case, right? That those expectations are not either clearly articulated, or the incumbent can't articulate them, or that they're the expectations from a year ago or 6 months ago, not for a year from now or 2 years from now.
Yes, the future-facing aspect of it is critical. For the CFO side, we didn't ask this of the private equity investors this time around. It's the first year of rolling out this type of data. We'll be sure to broaden this next year as we go deeper into the organization and broader into the CFO role. But however, the CFOs reported for themselves that establishing effective management reporting KPIs is a critical portion of the first 100 days, developing the relationship with the CEO. And from those free-form responses that we saw earlier, we really are looking from the CFOs to develop trusting relationships in particular. It's not just that you can speak in a convivial and congenial manner, that you understand what it is that the investment is going to require of you, but rather that you can create a tried and true trusting partnership with this person so that you can execute as a team moving forward. And then lastly, again, a heartening response, assessing the financial team, right? With the investment, with the injection of capital into an organization, what's required of us is a different perspective on the way that we track our financials at times and the way that the financial organization is run. So assessing that team is viewed as overall quite critical. Great. How we assess performance. Ted spoke a bit earlier to the factors that are assessed, the what, and this is the how. And again, we're seeing some concerning differentials here. Nothing that's terribly surprising, but something that we want to make sure is on everyone's radar so that we can not only balance the scales, but really make sure that we're taking advantage of the opportunities that we have to gain alignment and to make sure that there's real clarity on what success looks like. On the CEO side, again, not surprisingly, business reviews, real-time metrics, some informal relationships, some back-channel conversations with direct reports and others that inform this overall perspective as to how the CEO is performing in his or her position. Whereas on the CFO side, an overwhelming 73% stated that individual performance reviews, which would be largely based in those KPIs and those individual performance metrics, are what drive the overall perception of their performance. Then, of course, business reviews and real-time metrics are shared between the two. But the idea here is understanding that individual performance reviews should not be specific to numbers-driven roles. They shouldn't be specific to the rank and file of the organization. At the leadership level, and particularly at the CEO level, there are still opportunities to create very specific accountabilities and understand that specific actions and outcomes are expected of that individual in order to demonstrate success. Those would load on very seamlessly, in our experience, to an actual performance review, so that we can sort of limit this, what very well be muddied process of gaining intelligence through unvalidated channels.
Yeah, basically we're asking, we're really asking that people think about elevating the evaluation, the regular evaluation of CFOs to be more like evaluations of CEOs, and that their recognition that they have very important operational management and even talent-related roles, that their reviews actually align more with that. The bottom of the slide is something that's extremely important to us, which basically says that investors, boards, sponsors wait too long to remove an underperforming CEO. And now in our fourth year, we have an abundance of data on this. Only 31% said that they begin, that when they're certain that there's an underperforming CEO, only 31% that say that they begin the process of replacement to terminate. I think many boards think that coaching or mentoring or inserting an operating partner could help, and in most cases that ends up prolonging and delaying the problem and costing money and costing IRR in the long run. There are certainly instances in which a CEO can improve in his or her leadership or management capability, and executive coaching can be invaluable. We think that it occurs about half the time it's being tried, and so we're making our case that sponsors wait less long to replace a CEO than they currently do.
Yeah, the idea here is not getting married, not falling in love with any single individual, particularly because underperformance, identified underperformance, really makes problematic that type of relationship, because you want to preserve the individual for his or her strengths that you've identified, yet the overall underperformance within the role should indicate, a potential for being exited despite a remediation plan. We don't have a problem with that happening at times, but the 52% metric really is a bit too high for safety.
And just keeping an eye on the clock here, Josh, you want to talk quickly about executive turnover?
Yes, we can go through these next two slides quite quickly. Executive turnover is, across respondent pools triggered by a few different things. Lack of capability to execute on strategy, I think it wouldn't be a surprise to anyone. Lack of urgency, as was indicated in the earlier freeform responses on the private equity side. From the CEO side of the portfolio company, we see a clash of working styles with the PE firm. We also see that over on the portco CFO side, so really important that we establish these operating boundaries and norms between us early on so that clash doesn't come about. A lack of alignment on execution strategy, a clash of working styles with the CEO on the CFO side, and then a couple others that we see underneath the private equity side. The message here is that this is sort of a preventative health slide, right? This is a slide presenting data that is largely addressable very early, if not before an acquisition is even made, so that these issues don't come up and we don't see the type of turnover at the top that we do.
Right, and just to repeat that excellent point, Josh, each one of these conditions or each one of these reasons can be avoided with adequate due diligence and with the expectation and alignment workshop up front. Each one of these things can be predicted. And, to a very great extent, turnover is really an indication that they weren't properly assessed.
Absolutely. So this is our last slide before we turn it over for some question and answers. Just looking at the data, 70% of private equity investors prioritize the retention of their portco's existing management team, while 19% reported that they seek to install a new team. Of those folks on the left, what we see is an imbalance towards the retention of the CEO role in particular, 95% saying that they always or often include that retention as part of the investment thesis. But then speaking to a lot of what we've already been uncovering as part of this analysis, only 47% say the same for the role of CFO with regards to whether or not they retain the person in the role as part of the investment thesis. The idea here is that there's an opportunity to really change perspective with regards to how a CFO is a strategic partner, an operational partner, someone that can be really relied upon as a communication channel for the board and the private equity investors, and to consider that role as a bit more of a necessary factor with regards to the investment thesis itself. The last point that I'll make here on this slide is the bottom bullet. Sponsors who do not cut underperformers loose sooner rather than later will then have trouble finding replacements and risk having key CXO roles, so any really C-suite roles, sit either vacant or with an underperforming executive in them for a lengthy period of time. And we could be talking for periods up to 1.5 or 2 years. And this, this starts at the point of, identifying underperformance, exiting, engaging a search firm, conducting the search, conducting assessments, and overall onboarding. We're looking at a period that arguably is the riskiest type of lengthening of an investment cycle that you would want to look at.
Well said, Josh. Yeah. So now let's see what we've got for questions coming in. Let's see. Oh, here are several. Give me just a few seconds. I'll take one and then you can take one, Josh. Okay. So how do you overcome pushback from the target portco when requesting senior team assessments in the due diligence phase? I would say that, first of all, over the course of my career, the last 25 or 30 years, I find pushback occurring less and less as the real positive dimension of this work really takes hold, and operators and investors really live through the value of what assessment and alignment and workshops like the ones we described really mean. So I think the resistance is getting less and less. One way to work through it when it does occur is to have the CEO or members of the management team talk to other executives and other private equity-backed firms who have had this kind of work done, obviously as a positive testimonial. Another way is to really walk them through exactly what's going to happen and what the output looks like. So there are certain ways in which the resistance that is to some degree natural can be resolved.
So another question, how is adequate access to management teams typically sufficient to truly assess culture during due diligence on an acquisition? I'm going to hang my hat on this word adequate access, understanding that adequate means that there is access to begin with. In our experience, and I think quite broadly speaking, access is limited during due diligence, right? But that has typically meant that the response is, okay, so we can't do these types of things at all. And the reality is that we can get significant data to inform investment decisions as part of due diligence, even with limited access to the management team. Of course, what we prefer to do in our experience is to partner directly with the acquiring, with the acquisition firm, so that we can be communication partners with them, understanding that, at the top of the house, if we can get alignment and say, we're here to help, right? We're here to help understand your company. We're here to point out what you're great at. We're here to help you understand what it is that you can improve as part of your acquisition, because the data that we deliver is both beneficial then on the private equity side as well as on the, the acquisition target side. So to simply answer it, it is generally sufficient. We have problems. We have some issues, but we've also had some circumstances that have been almost identical to post-acquisition in terms of access.
Okay, another question coming in. When do you arrange for the workshop in the post-deal phase? Do you set the expectation during deal negotiations or post-deal? We certainly recommend that we talk about it during the pre-deal phase. We talk about it, of course, very positively, because that's exactly what it is. It's a positive, proactive, as Josh referred to, kind of preventative health exercise. And then we seek to have that occur in the first 30 to 60 days after the closing. And again, it's done with a little bit of fanfare, a celebratory dinner. The facilitation of the workshop is very, very important, so that people have literally good feelings about working together, and talk a lot about, not just what they want going forward, but they also we help them speak about when trust hasn't worked well in past investment relationships, what's gone wrong, what should we avoid. And it's a very, very much a kind of clearing of the air, and a way of really starting fresh and starting aligned. And we've actually had clients, and we've had both investors and portcos want to do it on an annual basis. We certainly think it should be done at the very, very beginning, but can be easily revisited and managed as time goes on. Do I think we have time for one more question?
One more, I think so. Would love to know what % of PE firms in due diligence, i.e. pre-deal, do formal structured assessments conducted by a trained assessment professional, which could include an employee, sorry, I'm just reading which could include an employee of the private equity firm who's been trained. So unfortunately, I don't think we can give a straight percentage, but what we can give is anecdotal experience. And this is happening more and more, right? We are being brought on almost overwhelmingly by some private equity firms, both large cap and mid cap, to do these types of due diligence assessments. I think, again, speaking back to my earlier answer, the structure of the assessment looks different, right? We cannot generally get to the same level of depth with individuals or with the organization that we can post-acquisition, yet we can get very actionable data from a lighter touch that's really informed by the level of access that we get. And the last part of the question, by a trained, which could include an employee of the private equity firm who's been trained. In our experience, that's generally counterindicated unless that person is, an operating partner that works in human capital specifically. We see those folks put, planted internally to address internal concerns at private equity firms, but they do portfolio type consulting. We just don't see those functions being built out very deeply yet. So, we have to think about that a little bit more.
Great. Well, we are out of time. Josh and I thank you all very much for participating, and we look forward to next time. Take care.
Thanks to all our participants for joining us today. We hope you found this webcast presentation informative. This concludes our webcast. You may now disconnect. Have a good day.